to a story that we've kept our eyes on for, quite frankly, the past week, longer than that, but let's focus in on the past week. So we're talking about stocks. We're talking about tariffs. So here's the latest news. I want to read what AP News has on its website. So on its website, on AP News, some relief is flowing through financial markets worldwide Tuesday as stocks bounce to recover a bit of their historic losses since President Donald Trump dramatically raised the stakes in his trade war last week. The S&P 500 was up 3.7% in morning trading. Through it still remains more than 14% below its record set in February. Again, I just want to reiterate for you, and it's from AP News, U.S. stocks rise as global financial markets show some sign of relief. So right now, I want to bring in Mike Walden. He is William Neal Reynolds Distinguished Professor and Extension Economist at NC State University. Thank you for your time. Mike, I know this is a big topic for a lot of folks, top of mind. So we hear this news about stocks are up after historic losses. I guess what should people know right now? Because it seems, for the everyday man and folks that I talk to or text me, it seems a little confusing.
Well, it's not good to talk to you, Nick. The stock market clearly has been driven by the tariff policy of the Trump administration over the last week. Stocks went down because investors and business people pretty much in concert think tariffs, at least in the short term, are bad for the economy. Why do I say that? Well, if you have a company, let's say an auto manufacturer that's located here in the U.S., they don't have all the parts made here. They're made in other countries. So you're going to have a tariff on those parts, which raises the cost of making an automobile. You have lots of people, let's say you have a toy retailer, a store that sells toys. Most toys are now made in China. Now, whether you like that or not, but it is what it is now. Tariff, presidents talked about maybe 100% tariff on those toys. Now, that gets to another point. Who pays the tariff? I think a lot of people think that exporter, let's continue with the Chinese toy example. They think that the toy manufacturer in China pays that tariff. That is totally wrong. It's the importer, it's the U.S. company here that's buying the toys from China who pays the tariff. And what's that importer going to do? He or she is probably going to try to pass on some of that tariff cost in terms of higher prices. So that gets to the second problem with tariffs. Likely we're going to see consumer prices go up. When prices go up, people can't afford to buy as much, and so you have a slowing economy. So this is all wrapped around what do these tariffs do to the economy, at least in the short term. I understand the president wants to encourage more manufacturing in the country. That's a long-term goal, though. We're not going to move toy manufacturers here to the U.S. overnight. So this is all gauged around the fact that there is a lot of pain from these tariffs, at least in the short term. Now, why is the stock market going in the opposite direction today? It's because there's news out of Washington that the president may be willing to negotiate tariff levels with other countries. One of his issues, and I agree with this issue, is that most foreign countries, when we sell them something, they have a tariff, but it's much, much higher than our tariffs before what the President Trump has done recently. So what President Trump has said is he'd like to potentially negotiate with other countries. He implied this yesterday when he was meeting with the Israeli prime minister, and negotiate tariffs on both sides down to a lower level. The fact that that's a possibility, I think, is why the stock market is reacting today a little more positively.
And there's two sort of questions I've been getting a lot. One, how much is this going to cost me in the short term? And then two, for folks who are closer to retirement, what does this do for my 401k, especially today when we see some sort of relief in the financial markets?
Let me take the second question first because I get both questions, but I get a lot of the second question. I'm not a financial expert. I'm actually retired from NC State now, but I run a private consulting business. But part of it is not to consult with people on what they should do with their investments. So let me say that out the front. But people always get mad when the stock market goes down. They're always happy when the stock market goes up. I understand people with 401ks. I have 401ks from my time working that I'm still invested in. When the stock market goes down, if you have most of that money in a 401k, you're going to lose a lot, at least in the short term. There are two questions here. What do you do now? And then what do you do long run? What you do now, I think, is probably nothing. You just grin and bear it. Hopefully we're going to get better news about tariffs. Hopefully we're going to see negotiated lower tariffs. If that happens, the stock market is going to come roaring back. What you wouldn't want to do now, if let's just say theoretically this is the low point before the stock market comes roaring back, you wouldn't want to get rid of. You don't want to avoid that or miss that opportunity for a rebound. So I would do nothing. This is not the first time in history that the stock markets have these wild rides. But secondly, especially if I'm in my 70s, especially someone who is older, who is going to rely in a few years on that money for their retirement. When this all calms down, you want to look at your portfolio and you want to certainly still have some of your money in stocks, but have most of your money elsewhere in things like bonds, real estate, precious metals, etc. You want to diversify, and you really want to diversify when you're older. So I think what this might be a wake-up call to some people, particularly older people like me, is that you want to make sure you're looking at where your money is invested, and don't forget that. How you invest when you're young. If I have someone that I see in the gym who's 30 and they're saying, "Oh gosh, this is horrible," I say, "You've got 50 years ahead of you to invest. Don't worry about it. Don't look." But if you're someone like me, 75, who knows they're going to need that money in a few months, perhaps, or a few years, you want to make sure that you've got it spread widely and not concentrated in the stock market, because the stock market is volatile. It's the most volatile of investments.
It's Mike Walden here, live on Live Impact News on WCNC Plus. Thank you for your time here on Live Impact News, and I just want to point out, Mike, you're not old.
Well, thank you. I appreciate it. I'll tell my doctor.
Well, we're going to have you back on because, again, this is a story that's going to continue to be here in the news cycle. So we look forward to having you back on Live Impact News, Mike.
Love it. Thank you. Thank you, Nick. Bye-bye.
All right.